Hi everyone, I am Kristen Gray and welcome to MNP's Spring 2025 Agriculture Industry Update webinar. John Lepke, a partner within MNP's Farm Management Consulting Group, will be providing us with an update on the Canadian ag industry and how both local and international factors are expected to influence various subsectors. I am a Senior Vice President with the Corporate Insolvency and Restructuring Group at MNP Ltd, a division of MNP, which is one of Canada's largest professional services firms. At MNP, we have a specialized client service group, which we refer to as niches. Ag is one of MNP's oldest niches, dating back to 1958. Within our ag niche, MNP has hundreds of professionals from various service lines across the country, specializing in many subsectors such as food and manufacturing, intensive livestock, primary producers, HUD rights, cannabis, and farm income programs. MNP's Farm Management Consulting Group participates in all engagements that intersect within the ag industry, including insolvency and restructuring. Farm Management Consulting has assisted the Insolvency Group in the past with forecasting, viability assessments, and day-to-day management of ongoing farm operations. John Lepke, our presenter, is a professional agrologist with over 20 years of experience providing advice as a trusted advisor to the ag industry. John grew up on a farm in southeastern Manitoba and started his career as an ag lender, eventually transitioning to a consultant. Our webinar has been pre-recorded to allow you to watch it on your own time. At the end of the presentation, you will find contact information for John and myself. Please do not hesitate to reach out with any questions. And so without further ado, I'll turn the floor over to John.
Thanks so much, Kristen. We will get going. So just a quick outline or agenda. I think, we're going to talk about the obviously Canadian ag industry and where we see things going forward. We're spring of 2025, so we got a couple of months under our belt, but we'll see if we can't see what's coming up in the future here for some of our major commodities. We're going to start off with, I think we always talk about starting with the market fundamentals. We're going to talk about trade, probably have lots to talk about there. And I'm sure by the time maybe you're consuming this, some of these details might have changed already. So just a word of note there. And then we'll kind of roll through some of our major commodities, at least for this presentation, poultry, dairy, crops, hogs, and beef, and just kind of see what's impacting them as we go forward. So to start off with, we always want to talk about some of the market fundamentals just to kind of, get our minds wrapped around what's going on in the world today, maybe looking at things from a lens outside of Canada, maybe a bit more global. Definitely lots in the news right now. So I think, supply demand is always one of those factors, right, that we want to talk about in agriculture. We're producing largely commodities. And so those supply demand curves are really something that, we always say that supply is kind of quick to change. Demand stays a bit more steady. And as you see kind of some of those markets and the pricing shift, you're hearing about different parts of the world producing, having a good crop or a bad crop. And that's kind of adjusting sometimes the pricing. And in a perfect world, obviously, that would be where we would end. We'd kind of just leave it there. We'd have perfect price discovery. But obviously, big news is trade, and more than ever, we want to talk about trade today and how it's changing and modifying and kind of upsetting some of that supply chains that we traditionally have had, and obviously impacting pricing potentially as we go along. Supply management, something that's mostly unique to Canada, where we try and match the supply to kind of what the consumer demand is for the end product, affecting our dairy, our poultry industries, our feathers. And even there, where we have a lot of intervention to make sure that supply and demand is really closely matched, we still see that what's happening around the world is still impacting them. Even some of the trade stuff is definitely starting to impact them. But we'll get more into that as we go along. Start off with, I think we want to talk a little bit about the U.S. The U.S. is our largest trading partner when it comes to agriculture, bar none. It's convenient. They have a large, obviously, consumer base that we want to sell our product into. So, yeah, just want to understand that a lot of the pricing of our commodities comes out of the U.S., Chicago Mercantile Exchange, a few others. So we do have to be aware that what happens in the U.S. does impact us here in Canada. Their trade negotiations, what's happening in their industries, and in this case, kind of what that FX is. So you can see that the Canadian dollar, longer term here has been kind of weakening against the U.S. More recently, I guess, it started to strengthen again. So just even though the actual price, let's say that a farmer's receiving might be static in U.S. dollars, once you convert that back to Canadian, we're seeing maybe the dollar strengthening. Obviously, a little less good, if we want to call it that, for anyone exporting. But if you're importing, always good. So, I think from our perspective here in Canada, where we export more than we're importing, I think we obviously want to see a bit of a weaker dollar, but lots and lots goes into that discussion of how weak we want the Canadian dollar versus the U.S. I also threw the euro in there. Just I think there's lots in the news these days about getting away from dealing with America and looking at alternate markets. And agriculture, I think, is impacted by that discussion as well. And so just want to throw in there a little bit. Yeah, if we are looking at some different markets, say Europe, for example, that's maybe something to consider as well, is what that exchange rate looks like. A bigger discussion on, some of the regulatory environments in Europe compared to America, and whether that's a good idea to look to sell ag commodities into Europe or not. But just food for thought if we are looking at Europe, either importing or exporting. Yeah, there's kind of how our exchange rate kind of stacks up. So the other one that we want to kind of chat about before we really start digging into the trade side, is interest rates. Obviously impacts all farmers one way or the other. And I kind of threw up here kind of that 5-year floating rate. And you can just see, it obviously 3 years ago went up quickly, and we're seeing it go down quickly. How far down we're going to get remains to be seen, but we're definitely seeing that coming off of its near-term highs anyways. And so we're starting to see that softening of interest rates, which always makes the bottom line look a little better. Maybe also spurs on some reinvestment in farms. Obviously, lots goes into that decision, but interest rates usually is one of them. So we're starting to see that come off a little bit. And I think, we're probably getting to the point where most farms, if they took a 5-year rate, back in 2020, let's say, probably at some pretty low rates. Now they're going to be renewing into some higher rates, and we're starting to see that, we're kind of getting closer to the end of that 5-year cycle where, there's probably not a whole lot of those really low 5-year rates left out there that farmers are still enjoying the benefits of. So once we get into that interest rate renewal, I think we've seen probably lots of impact already, but we're just coming to the end of it, I'm guessing, on lots of farms. And the impact can be pretty big, right? Depending on how leveraged you are. Sometimes that interest rate sensitivity can be pretty extreme. Even if we're just talking, 50 beeps or even less than that can make quite a difference, especially when margins are already compressed in some of these commodities that we're going to be talking about as we go forward here. So that's kind of it for interest, or sorry, one more slide on interest rates. So last kind of thing on interest rates here, the Bank of Canada announced kind of no change April 16th. I think they're seeing that probably the inflation is at a point where they're happy with for now anyway. So we're not seeing much in the way of change there. Next announcement's coming up June 4th. I think the expectation is probably not much in the way of big changes, right? Maybe small cut as we go forward, depending on where inflation goes and a bunch of other things. But yeah, I think we've probably heard that term soft landing. So I think they're hoping that they can regulate it so that our inflation kind of probably sticks around where we're at today in that 2 to 3% range. So yeah, and as I mentioned, lots of Canadians in general, and obviously farms as well, are still adjusting to some of those mortgage rates that are different than what they would have renewed into probably in that 3 to 5 year term. So that's probably it for interest rates. All right, so we got probably a big topic to talk about today, and that's trade and how it's kind of affecting Canadian farmers. Obviously, the relationship between Canada, US on the farm side, as kind of the picture kind of indicates there, it's been pretty agreeable for a long time, right? There's been a lot of benefits to having a fairly integrated system, and to the point where we see even some Canadians setting up shop in the US. I think we see probably the hogs, the beef, to a certain extent, grain is really integrated in their system and really intertwined. And it's taken, decades probably of change to get us there. Supply chains have all adjusted. And so we've got this really integrated system between Canada and the US when it comes to some of the major ag commodities. And so over time, though, that we renegotiate trade deals, CUSMA being the last one, right? And so those are points maybe where there's a little bit more friction, but definitely we're seeing, I think, a lot more friction, if we want to call it that, right now. So I think we'd say there's storm clouds between the two countries currently. And definitely we're seeing that impact agriculture to a certain extent. Those good relationships that we've had are definitely getting tested at different levels, and I think everyone's hopeful that we kind of go back to the way it was for the most part. I think there were some real efficiencies in that. Obviously, like I said, it's taken decades to get there, and I guess maybe just a note is, cost of production still kind of rules at the end of the day. So lowest cost of production is always where, I guess those commodities run to. So, canola, for example, in Canada, we'll talk about a bit later, but, our cost of production on canola is probably the lowest in the world. That's why we do it. That's why we're good at it. And so it's just finding all those different areas where you've got, I'll call it that competitive advantage in agriculture. Lots of times it's just cost of production, right? So, but as we kind of navigate through this, we're definitely seeing that these trade negotiations, if you want to call it that, are definitely a little more bumpy, and largely due to obviously the fact that the U.S. has Trump in as president, right? So. And I think that is how his MO is, how he likes to negotiate, is just create chaos. Get everyone on their heels to a certain extent, and then find opportunities where he can go in and get a better deal than what was there before. But first, we got to create chaos, and so I think we're in that stage right now. So here's a little bit of kind of where we are. The U.S. Has put 25% tariff on goods not compliant with CUSMA. And I think really important to kind of highlight here that most ag products and ag commodities are compliant with CUSMA. So a lot of the stuff is not necessarily impacting the commodity, but there's still impact to farms in general through some of these other tariffs that are happening. So, one of those is obviously that 25% tariff on steel and aluminum. Anytime you're talking equipment, that's gonna start impacting you on that side. And then 10% tariff on imports of energy and potash not covered by CUSMA. So that's what the US has done. Canada obviously has done some reciprocal tariffs, 25%, on steel and aluminum, 25 on other goods valued at 44 billion. I think right now in the news, as we record this, the automakers is probably getting lots of airtime. So 25% tariffs on US made vehicles. I think there's currently some talk around, some relief in certain areas there. And then obviously US components of CUSMA compliant vehicles made in the US. So as I said, a little bit of back and forth as we go along. We'll see where it all shakes out. I would say one thing we are telling our clients here is, you got to obviously be aware of the tariffs and how they might affect you, but you also have to be aware that a bunch of it's just noise, right? And it is just creating some chaos, and we're not seeing a lot of actual tariffs come out of it. So the impact is still a little bit unknown yet, right? So as much as we, as business owners, you do have to keep apprised of some of these situations and take note of how it's impacting and potentially impacting your business. To a certain extent, I don't think it's probably good business sense to spend all your time purely concentrating on tariffs, especially for lots of the farmers and producers in Canada, where we're not certain exactly how it's going to impact farms just yet. So due diligence required, but I guess word of caution: just don't go overboard on the due diligence side. So the next front obviously is trade with China. As much as we've got some issues with US, we also have issues with China, which is another major customer of ours when it comes to the agriculture side. So and I think when it comes to China, we're talking probably more specifically canola. So more than half of Canada's canola exports land up in China, whereas almost all of that China imports comes from Canada, almost 94%. So how these tariffs came about was, largely seen as retaliatory based on Canadian tariffs on EV vehicles and steel and aluminum, and we were just following suit with the US, right? So we kind of got caught with that one. And so, China imposed additional tariffs on Canada March 20th, 100% on canola oil, peas and oil cakes, and then 25% on aquatic products and pork. I think it's probably worthy of noting that they didn't do canola seed. They did oil and oil cakes, and they definitely import way more seed than they do the other two products. So they kind of left off that major product that they import. That being said, though, the exports of canola oil meal and peas into China is about 1.2 billion in 2024. So definitely something, obviously, we still want to keep apprised of. And Canada does export about 10% of our pork into China, valued at about 469 million in 2024. So again, yeah, Canada's kind of faced with two of its biggest export markets, both kind of we're in trade battles with currently. So definitely some interesting times as we go through this. It seems like things do change on a regular basis, and the tariffs just seem to keep going higher and higher every day. So we will see where it all lands up. I'm sure when we do this again in the fall, we might still be talking about this because these do seem to be longer term items that do take a long time to actually resolve themselves. So, we also want to look at trade between US and China. And some people might be going, well, why would we really care about what happens in between US and China? As mentioned before, right? A lot of our commodities are sold into the US and then sometimes they're further sold there. And a lot of times the pricing of our commodities is based in the US. So if all of a sudden they get impacted with some trade item on their ag commodities, it does affect sometimes the price that Canadians are going to see here as well. So, but yeah, Trump has, as with lots of other countries, decided to start an economic war on China. So April 9th, China responded to the U.S. tariffs by imposing, restrictions on 18 U.S. companies. So being even more specific than just tariffs. And then 84% on all U.S. goods. And then there's retaliatory tariffs where the U.S. raised it to 145%. So definitely escalation, I guess, is the word that we would see there. I think the one in this that Canadians really should be looking at is probably soybeans. As we mentioned in the slide there, soybeans are the U.S.'s number one export to China, valued at 12.8 billion. So if all of a sudden soybean stops going into China, we're definitely going to see probably the value of soybeans drop, at least temporarily, and that's going to impact Canadian farmers as well. So depending on what side you're on, right? If you're livestock, maybe not as bad. You're seeing some of your inputs go down. If you're on the grain and cash crop side, obviously, now your cash receipts are going down for soybeans. So. And beyond that, Trump declared kind of April 2nd as Liberation Day, implemented a 10% tariff on all countries, with some exclusions. 86 countries face additional reciprocal higher tariffs ranging all the way from 11 to 50%. So it really seems like an all-out war on all other countries. And again, and this is why we kind of have a word of caution. There was, after all the rhetoric and the chaos that ensued, Trump did put a 90-day pause in while he tries to make deals with other countries, right? So that does seem to be his preferred negotiating style. And so I don't think it's going away. I think we're going to see more and more of this as his administration continues. I think we're going to see this in the news all the time. Some disruption happening, and that's just something we're going to have to get used to. And after a while, I'm sure people will adjust, I guess, their response in how seriously they take stuff, and their response in their business on what they actually do. So what is, in all of this, what is Canada's response been to farmers, right? A lot of times we're getting into these trade wars. It's not necessarily that, that say canola has offended China in a certain way, but it's just it is a pawn in the piece of the puzzle. So the Canadian response really has been to kind of beef up some of the BRM, the business risk management programs that are already in place. So AgriStability, they have temporarily, at least for this year, increased that program cap from 3 million to 6 million. So definitely helping out some of those larger farms that would have, margins dropping significantly to the tune of maybe $6 million. They also raised that compensation rate from 80% to 90%. So again, just a higher inclusion rate, which means if you are in a position of triggering the program, you're just gonna get even more funding out of it. So definitely something I think that we're hearing is the preferred route for Canada to provide any sort of help out to farmers is through AgStability. So we would definitely encourage everyone to take a look at the program if you're not already in it and enroll as that seems to be the way the government would likely be pushing funds out to anyone impacted. The other thing is the APP, the Advanced Payment Program. They have increased the interest-free limit to 250,000 for this program year. So it was 125. They've doubled it up to 250. So again, not necessarily that farmers want more debt, but if all of a sudden working capital is being impacted, then getting some interest-free money is always welcome news, I'm sure. The other one is through Farm Credit Canada. They're providing $1 billion in new lending through their trade disruption customer support program. So as well, look at that program if interested. Again, I think we always hear farmers don't necessarily want more debt through this, but definitely there are some options out there. Okay, so we're kind of done with the trade side, and so we'll move into the commodities here and go through and see what things are looking like for, I guess, all the different major ag commodities, anyways, across Canada. So first one we're going to start with is poultry. Within poultry, we've got eggs, chickens, and turkeys as kind of those major commodities. And I think, we're kind of seeing chickens, that demand has been very strong, and I think it'll continue to be strong, but maybe not quite as at growing at the same pace. Just, we're kind of seeing that population growth in Canada really spiked, and then we're seeing it kind of slow down now. So we're probably going to see that chicken demand slowing a little bit as we go through that. Definitely, I think turkeys is one where we're seeing some headwinds. That demand for turkeys just seems to be getting smaller and smaller. I know talking to you, Dave, from Winnipeg and definitely in Manitoba here, we're seeing, producers are being curtailed on filling their full quota just because the demand is not there. So, on the egg side, I think we are seeing probably more demand and largely, I'm sure everyone has heard, AI outbreak in the U.S. was fairly severe and impacting egg production down there, and that's trickling up here into Canada. So there's, as much as supply and demand does try and match the two fairly evenly, there always is a little bit of I guess gap there, and traditionally that gap has been filled by buying eggs from the U.S. and with the high price of eggs in the U.S., we're definitely seeing that that's impacting our processors up here. And so currently there's the ability to overstock on the layer side, and so you can overstock the densities, which my understanding is just for the enriched cages, if you currently have those, to allow for that increased production to kind of make up for some of the production that hasn't been coming in from the U.S., although definitely on the smaller side. So I don't know, I think in general, that's the outlook for the poultry side. Next slide, we're going to talk about AI a little bit and how it's impacting us, but and we'll get into it a bit more when we talk about the crop side, but definitely I think we're seeing the feed cost coming down. So anyone feeding livestock is benefiting from that as grain prices kind of slide. That's obviously a good impact on the livestock sector, poultry being one of them. So I think we're seeing some better margins than we have in the past for poultry as we kind of move through 2025 here. So just a quick comment on AI, seems to have stabilized here in Canada. This time last year, there were 14 premises actively infected. Right now we're seeing, I think, we're seeing 15. So, we seem to kind of leveled off. Estimated number of birds affected this time last year was 11 million. I think we're a little bit higher now, but so I think we're definitely seeing a more of a stabilization. And definitely, BC always seems to get hit the hardest through these, and this was definitely the case again, that province was largely the most affected. I think Atlantic Canada was hardly affected at all, and then varying as we went through the rest of the country. So, yeah, so big impact in the US. I think a bit less of an impact here. If I would guess, it's likely because just the size of barns that we build versus down in the US is different. We're typically smaller and more spread out here. So definitely when it comes to biosecurity and spread of disease, that's a big positive for us here. So. Moving on to the dairy side, I think we've seen some headwinds on the dairy side in the past, and few factors went into that, and I think we're seeing some of those factors kind of easing. So we're seeing profitability definitely coming back to a bunch of the dairy farms that maybe were having some challenges. So profitability is definitely stabilizing. As mentioned, I think a big piece of that is feed. Our feed costs are coming down. The other piece, though, is our fixed costs are definitely increasing. So those two are definitely working against each other. But I think obviously the biggest expense on a dairy farm is feed. So when you're seeing your biggest expense kind of drop, then that always leads to better profitability. I think demand is obviously been fairly strong. We've seen a lot of quota increases over the past year here. In the West, they're talking about further quota increases as some fairly major processors come online down the road. I think we're talking at least 2 to 3 years out, but definitely there seems to be a lot of talk about building new barns, increasing capacity as we look forward to potentially seeing some of these quota increases coming. Obviously, if you're not profitable today, it's going to be really hard to pencil out any sort of major expansion. So I word of caution definitely is that you're not going to grow your way out of this if you're not currently profitable. I think step one always is to get yourself profitable at the size you're at and then start growing. I think we've seen a lot of producers try and grow their way out of a problem, and it just unfortunately does not work. You just land up probably in a worse spot than what you were. So another thing we're seeing is just the processors are starting to look for kind of a different ratio, right, of that butter fat to SNF. I think as the market is looking for more protein, what we're seeing is that we're actually, as Western Milk Pool, as P5, we're almost overfilling our quota, but the processors are saying that they need more, and it's not that they need more butter fat, they just need more protein. So definitely hearing that the industry might be shifting a little bit in what it's looking for and how you're going to get paid for your milk. So nothing concrete yet, but just rumors of that's what we're kind of hearing as we go forward. So if we're kind of looking at profitability, gross margin is kind of what this slide is showing us. I think we're showing a little bit of a decrease from 24 in the projection coming largely out of FCC, I guess. And that's coming, I think, off of probably crop prices maybe strengthening a little bit and a bit of a different mix there as we go forward. I guess the other thing to mention, obviously, is we're seeing lots of dairy on beef breeding. As that beef market is quite strong. We'll talk about it when we go through the beef sector, but we definitely are seeing a lot of dairy farmers switching over to using sex semen and breeding to beef. And the interesting impact is that there's a lot less heifers for sale and a lot less heifers on dairy farms in general, because largely the impact of doing the dairy on beef is you're producing just enough heifers for your own facility, so or your own farm. So definitely we're seeing heifers at a premium from that perspective. And we're, yeah, adjusting a little bit, I think, the landscape on the beef side as we're seeing more dairy producers starting to breed to beef. So next, we're going to move and look at some crops. So we're going to look at maybe some 2025 seeding intentions for some major commodity crops, look at some farm equipment, and also look at the latest farmland values. As I mentioned, grain production in the U.S. is closely tied, right, with Canada. What they produce down there and the volumes and how it's priced is directly affecting us here in Canada, as all of our commodities are based off of that, except probably canola is about the only one that's priced out of Canada. So always good to just kind of look at what their intentions are in the U.S. And what kind of those American farmers might be thinking, because what they tend to plant is usually a good indication of how they're feeling, right? And obviously what the market's telling them to plant. So for 2025, we're seeing probably 95.3 million seeded acres for corn. That's up 4 million, or about 5% from 24. And the soybeans is about 86.5 million. That's down 4%, right? So we always see that mix between corn and beans, and they tend to trade acres back and forth depending on the market and probably which one farmers think they can make more money on. So currently in the U.S., we're definitely seeing farmers thinking that corn is going to be more profitable this year, and switching some acres anyways over to corn. Now, if we look at Canada and kind of what some of our seeding intentions are here, beans, same as the U.S., maybe just not as much, but we're estimating about 5.6 million acres. Hopefully gave you a little bit of scale there of where Canada fits in the bean market. We kind of pale in comparison to our huge cousins down to the U.S. growing beans. But again, ours are down as well, probably about 1.3% from last year, not as big of a shift. Canola, we are estimating, or we aren't, but Stats Can, I guess, is estimating about 21.6 million acres going in, which is down about 1.6%. So we're seeing both of those crops probably being a little less in acreages and largely being made up in wheat. So definitely farmers are thinking that there's going to be more profit in wheat this year than soybeans or canola. I think in general, canola is a risky crop to grow, high inputs, and so as some of these other options and opportunities are out there, we are seeing in general across Canada, I think more producers planting less canola acres. So also want to look at, some farm equipment and what kind of the trends are there. The reason we do that is I always say it's kind of a little bit of the pulse of where farmer sentiment is. So if you got a lot of money in your jeans and you're feeling really good about where you're at on your farm, we're probably going to be replacing equipment on a bit of a faster schedule. And if you're seeing some headwinds and you're seeing maybe that there's some storm clouds coming up in profitability on the farm, you're probably not going to be replacing equipment as quickly and probably looking to fix more. So the interesting thing is just that divergence between the U.S. and Canada. So I think we're definitely seeing, as the slide kind of shows, equipment sales are trending downward in the U.S. I think largely driven by that margin outlook. As we're kind of seeing profitability for some of your major crops in the U.S. Less than what they were last year. Definitely, a big one's going to be the beans, right? That's the other thing, as the U.S. is going through their trade war with China, and beans is obviously the major export out to China. Then I think that's another reason why we're seeing some of those bean acres move into corn acres. And in general, as farmers are feeling like they're probably going to be less profitable, we're seeing some of these equipment sales slow down in the U.S. Now, keep in mind they're coming off, probably 2 or 3 really, really good years. So there's definitely some good sentiment and some good working capital, hopefully that's been built as we go through that. But the difference, interestingly, is, looking at Canada and we see the opposite, right? We see tractors up, combine sales up, and from the outside just doesn't make sense because you're like, well, you just said everything's tied together and the markets are all intermingled, and so why would U.S. farmers be doing something different than Canada? Well, I think what we're seeing is it's largely driven by the tariff threat, is why Canadians are looking to buy equipment now because they're expecting equipment to be more expensive in the future once these tariffs do actually materialize. So, yeah, I think, anecdotally anyways, we've seen a lot of the equipment lots filling up as I think some of the dealerships are moving equipment in to try and quote unquote beat the tariffs. And I think that's relaying back to the farmers and they're driving up sales in the short term anyways. Now, if we're looking at some land values, FCC always puts out their land values report, and so we're seeing, in general in Canada, land values are up 9.3%. And you can see all the different provinces there in the slide. And, the interesting piece is that we have seen this increase for, as the chart shows there, going on 10 years here, where we have cumulative increases year over year over year. And so I think that's really changed probably the balance sheets of farmers when you're looking at it from a net worth perspective, right? That compounding increase over the last 10 years has been, quite phenomenal. And I think it also probably changes maybe how we look at farms. I know definitely when we start looking at some succession, we are definitely starting to talk more about family wealth and generational wealth. And it's largely driven by this. It's largely driven by land values, where the farm hasn't been, it's likely been profitable, but not to the extent that it's increasing the net worth to that extent. So definitely changing lots of different aspects. Lending obviously is one of them. But succession is also one that we're really seeing impacted as we have those discussions. Moving on to hogs, I think we're coming off a pretty good year in 24. I think the outlook looks okay for 25. We definitely, the first quarter has been all right. I think, as mentioned, yeah, we're going to see some lower feed costs as we go forward. And yeah, demand could be impacted by some of these trade disputes, right? Whether it's China and Canada or Canada and the US, we will remains to be seen a little bit. But as mentioned, especially on the hog side, there is just so many supply chains that are intermingled between Canada and the US. Pulling those apart would be detrimental to both sides, right? There's no winner in that for sure. So we just run a little bit of a forecast on, if you're doing fair to finish, kind of what your gross margin might look like. So I just kind of showed the last 5 years here and where we think potentially 25 might go. So you can see, 24 was definitely the best that we've seen for gross margin. We did see producers hit $95 a head, some even over that. And so we think it's probably going to soften a little bit down to $90 a head probably as we go forward here. Some of that's just increase on some of the feed cost side, and maybe a little bit weaker market as we go forward. So that being said, though, still really good outlook for the hog side. But I will say I think they need it because it's been before this been a rough couple of years for the hog producers. So definitely need to rebuild their balance sheets and their working capital because we know hogs are cyclical and there's another downturn will be coming. So definitely they need to look at rebuilding as we go through here. So yeah, so good outlook, I think, for hogs, which is nice to say. We don't always get to say that about the hog industry. Moving on to cattle, I think it's still kind of a fairly good outlook for the overall sector. It has been interesting as beef prices have moved up and up. Everyone had this premonition that, well, at some point the consumer just isn't going to buy beef, right? At some point the price is just going to get too high, and you're going to see that demand destruction, I think is the technical term, where prices just get too high and it just totally erodes demand. Interestingly, we haven't seen that on the beef side. We've had some, significantly higher prices as we've gone forward here, and they seem to be continuing. So part of that just is that there's just less cattle, right? Less cattle in Canada, less cattle in the US. So part of that is just that supply side is just being challenged and probably will continue to be challenged because we're kind of seeing those lower inventories continue. And just the breeding cycle of cattle, it just takes years to rebuild the herd. And I think that's part of the challenges that probably the industry faces, if we want to call it a challenge, right? From that perspective. So yeah, as mentioned, I think the Canadian herd is continuing to shrink, but there is signs that it's stabilizing. Cow slaughter is declining. More guys are retaining heifers. It's really hard, obviously, to sometimes retain those heifers when you can turn them into cash quickly for good margin, right? So imports and exports, forecasted to decline a bit. But I think, cash receipts in 24 were 11% higher compared to 23. I think we're probably seeing that stabilize a bit as we move into 25. But yeah, as I said, some producers may see this high price environment as an opportunity to exit. So, and I think that's the challenge with rebuilding the herd is when you've got these high prices, then some of the producers that have been in it for a long time of wanting to exit on a high and not looking to reinvest into further production. So that kind of ends our webinar for today. It's been great to kind of share what's going on in the industry with you, and I will turn it back over to Kristen.
Thanks, John. We appreciate your insight. So sounds like interest rates, exchange rates, and ongoing global events impacting trade, such as the US tariffs and other import-export trends, are currently important considerations for anyone interacting with the ag industry. Thank you to everyone who's chosen to watch our webinar, and we hope it has identified topics to be mindful of as you engage with your clients in the ag industry. If you have any industry-related questions, we encourage you to reach out to John or any member of our farm management consulting group across the country. If you have insolvency and restructuring-related questions, please do not hesitate to reach out to myself or anyone in our insolvency and restructuring group. An appendix has been included at the end of this presentation for further information related to our farm management consulting group and our restructuring group. You have received this link as you previously requested access to the biannual ag industry update webinar. Please feel free to forward this link to colleagues or contacts you think might be interested. The link will be posted to our website, www.mnpdebt.ca, and we look forward to providing you with another industry update in the fall of 2025. Thank you.